So you are all welcome back. I'm very sorry there is a serious service, both service and technical issue I'm trying to sort out before. So I noticed that I was unable to unmute my mic and not to talk of giving the lecture. So I need to just copy new link. You are all welcome. You are all welcome. You are all welcome. Please let's mute our mic. We start immediately, please. Then, so you are all welcome. You are all welcome. I'm very sorry for keeping you waiting. It's not my fault. So as a result of service and also the Google account I was trying to set up, there's a mistake on it. So I need to correct that instantly. You're all welcome. So we are going to start in the next 5 minutes. So let's wait for other people to join both on the YouTube as this is now activity is completed right now. Please can you confirm if you can hear me? Let me allow you to unmute your mic. Please can you all hear me now?
Hear you, yes.
Yes,
Okay.
yes.
Yes,
Okay.
sir, we can hear you.
Okay, you're all welcome.
Yes,
Please,
sir,
I'm
we can
very
hear you.
sorry for the mix up tonight. It's as a result of some extraordinary reason beyond our control. So we are going to start immediately. We are going to start immediately now. So we talked about IAS 23 last week and we are able to finish up the explanation. However, I've sent the notes to the group chat, and if you notice that there are some inclusion in the notes, let me just quickly brush up that within 5 to 10 minutes. So basically, what IAS 23 tell us is about the borrowing cost and what are we going to capitalize, what are we going to expense, when are we going to capitalize, and when are we going to stop our capitalization. So in a very summarized way, borrowing cost is all about the additional cost incurred on the fund that we borrow for a particular project that meets up with some specific capitalization threshold or some specific expectation. So once that project you want to embark on meet up those expectations, the additional cost we incur on the fund that we use to finance this project will be added to the value of that fund for us to arrive at the total value of the asset. And in most times, we need to pay a lot of attention to the question that we want to answer before we even start answering them. We need to be very careful in terms of the questions. Over time, if they decided to make it a 15-mark question, they'll be coming from the aspect of testing your understanding about the question in terms of giving you a scenario and giving you some incidents that might occur. Some will be the reason why the company should continue their capitalization. Some will be the reason why and when they should stop their capitalization. So we need to pay more attention to this, more like a word problem. So we need to pay more attention to the questions. We are going to solve 3 questions tonight, and we are going to start from the simplest one to the Vitamin PLC, which is one of the past questions. But before that, I want us to all have a general understanding about what IAS 23 is talking about. It's just simply about the interest, the finance cost that meets up the threshold, that meets up the rules and guidelines for us to add that interest to the fund that we borrowed, and we call it the sum or the total fund. After adding up the interest to the actual fund that we borrowed, we call it the value of the particular asset we use it to build. So that is just what IAS 23 is telling us, and we should all know that capitalization should continue as long as the substantial period that is going to take us to complete the building of that particular asset. However, in some situations, we need to stop capitalize if the reason why we stop working on that particular asset we are building is as a result outside the necessity, is as a result of our personal decision. The question will be clear, so we need to stop the capitalization for that period. On the same note, we need to continue the capitalization if the reason why we stop along the line is as a result of necessity, as a result of what we need to be done. That stopping period is necessary for us to be able to complete the building of the asset. So I'm saying all this so that when we go through our notes, everything is well stated there and well explained. And in case you have any question, you can actually reach out to me for us to clarify it together. So let's go straight to the question. Yes, I've not started sharing my screen. I've not started sharing. I'm going to start now. So I hope we all have the question with us already. So I will start sharing my screen now. Please confirm once you can see it. I have the plan that I didn't think we were able to join on time. We are going to look at if I was starting. So just like God wants it to be. So going to try that. It's a very simple IFRS, which I believe should not take up much time. Please, can you confirm if you can see my screen yet?
Not yet.
No.
Not yet, sir.
All right. I'm going to close this thing and reopen it again. We will see it now in a minute. I'm trying to reopen this thing. See. Can you see it now?
Yes, sir. Yes, sir.
Yes, I can see the screen now.
All right. Thank you very much. Please let's all
Yes, sir. I can see the screen now.
So I don't want to lock the speaker because it's going to be a calculation and people will have a lot of questions. But please don't let us abuse it. Please, when you have questions, raise up your hand. I'm going to call us, so that we can have. It won't be like I just bring up the solution and there is no any explanation to avoid people coming to my DM personally. So please let's try and mute our mic. We are not talking presently, and once we want to talk, we can unmute ourselves and ask the question we want to ask. So we'll be starting with APC Limited. So this is APC Limited. APC Limited started construction of an asset on 1st of January 20x7 with a loan of $55 million borrowed at an interest rate of 15%. The loan was used on the asset as follows. So this is the breakdown. So the construction of the asset was completed on 31st 20x7. However, during the accounting period, APC Limited has invested the surplus fund at interest rate of 5% on temporary basis before they were required for spending. So let me first of all explain this. Just like I said last week that let's assume Mr. Temitope borrow 10 million loan to complete a particular substantial asset, which is going to take a 10-month period. However, at the beginning of the month, which is the first month, Mr. Temitope did not withdraw the whole 10 million at once, but rather he withdraw 1 million naira to start the project, maybe to buy the land or to acquire what the first stage necessity of the project. You know, at that time when Mr. Temitope withdraw $1 million, he still have $9 million in the bank. Mr. Temitope, be a very wise business owner, now decided to invest this 9 million, pending the time that we need them, into a short-time investment for him to have a return within that short period of time. So, for any interest or any interest income that Mr. Temitope receive on this 9 million, you know, he borrowed 10 million, he's using 1 million presently, and is yet to make use of the remaining 9 million. He now reinvests this 9 million in a short-time investment that will earn him an interest income. The interest income that comes in from this 9 million, pending the time that Mr. Temitope will use it, at the end of the day, we are going to use this interest income to reduce our own interest. Don't confuse us. So let me take it again. Mr. Temitope borrowed 10 million at the rate of 10% interest. He's using 1 million presently. The remaining 9 million, he reinvests it in a short-time investment that is going to earn him an interest income of 5%. You know, Mr. Temitope will be receiving 5% interest from those people that he borrowed or he give out that 9 million to. At the same time, Mr. Temitope is expected to pay 10% interest to his own lender too. So at the end of the day, he's going to use the 5% interest income to reduce his own 10% interest income. You will get it now from this example. So I just want us to have an idea of what we want to do. So okay, this is APC Limited. I think we all have the question with us, right?
No, sir.
No,
No, we don't.
No, I will explain that along the line now. I will explain that along the line.
Please help us send the material again, sir.
I think I'll send this to the group chat.
At the same time, Mr. Temitope is expected to pay 10% interest.
Okay, let me resend the material again.
So,
please let's move to our mic. Let's move to our mic. Let's move to our mic, please.
Thank you.
Let me quickly resend the material to the group chat once again. But I've opened it, so I want to look for it and share it to the group. Okay, this is it. Sweet. I think. So I'm sorry. I want to share it to the remaining group using my phone. So I'll share it to us again. So let's continue. So if you don't have it, please kindly download it now and open the question. So this is the question. Let me try and enlarge it so that those people on YouTube can see it as well. So just like we have it, that APC Limited, they borrowed $55 million, and we have it there how they withdraw it for the project. So we are required to calculate the borrowing cost eligible for capitalization as at 31st December 2007, and also the cost of assets to be reported in the financial statements. They will be reported in the statement of financial position as at 31st December 2007. So this is what we are going to do. We have the breakdown already on how they withdraw it. January 1st, they withdrew $25 million. You know, as at this January 1st and before 31st of May, that they withdraw the $25 million, they have the remaining funds in their bank account. So that remaining funds that they have in their bank account is what they reinvest. At this way, that we're telling us APC Limited has invested the surplus fund at an interest rate of 5% on a temporary basis before these were required for spending. So for the first 25 million that they withdraw, multiply by the 15%, and can we unmute ourselves? Can we mute ourselves, please? I think I need to mute us up. You have questions.
Please, sir, can you just mute everybody?
So let me explain. So on the 1st of January, 25 million was withdrawn from the total of 55 million that was being borrowed for this particular project. And the rate of interest we are expected to pay is 15%. So it's very straightforward. 25%, 25 million multiplied by 15%. Now, the money is being withdrawn on the 1st of January. The money is being withdrawn as at the 1st of January. So we are going to calculate, we are going to consider the month that we are going to spend with the money. You know, the general interest to be paid is 15%. So we are going to consider the month, which is 1st of January till, what is this date? Okay. So from the 1st of January till when we make our next withdrawal. So here we have, sorry please. So the first withdrawal, we are going to charge our 15%, which is 15% multiplied by 25 million. Then also the month, which is 12 month period of time. And then our second withdrawal comes in as at 31st of May. 31st of May 20x7. 31st of May 20x7. Then they withdraw 15 million. So we're going to charge our 15% on this 15 million too. Then the last withdrawal is on 1st of October 20x7 as well. So we are going to charge our 15% on this. We are going to charge our 15% on this. on this last withdrawal as well. So all the 15% we are charging on each of our withdrawal are what give us this interest that we have here. They are the one that give us the interest we have here. They are the one that give us the interest we have here. So, you know, we have two sources of fund. We have a specific fund, just like what we are doing now is a specific fund, and we have a pool of funds. So for specific fund, irrespective of when the company withdraw the fund from the bank, irrespective of the month, the interest is going to be calculated on a 12-month basis period, irrespective of the month that we withdraw the money. Just like we have an agreement with bank now, and the bank give us at a specific rate, just like we have it here, the bank give them at the rate of 15%. So irrespective of the month that the company withdraw the month or make use of the fund, the interest is going to be calculated on 12-month basis. So it's going to be 12 divided by 12. So we are not going to prorate it. Just like we have the one that they withdrawn in May, and they withdraw another one in October. So far, the money has been disbursed to them as at. So far, the money has been disbursed to them as at 1st of January. The interest that we paid on it is going to be on a 12-month basis, irrespective of when maybe they withdraw it in May or they withdraw it in October. There's an agreement in place already between them and their borrower. Like, we are going to pay 15% interest charges on this 55 million. So it's not left to you where you make use of them, or maybe you did not make use of them. It's none of their own business. All they know is that based on agreement we are, maybe your interest is going to be coming in on a monthly basis, or you are going to pay your interest in a lump sum. You are expected to pay the actual interest based on the agreement you have with them. It's not left to you. Maybe you make use of it in May or you make use of it in December. Agreement stated that 15% interest to be paid annually per annum. So they will calculate the 15% per annum. So if you had an agreement to be paying it on monthly basis, you are going to divide it by 12, and you'll be remitting it as at when due at the end of the month, at the end of each month. And if you have to pay it in a lump sum, you are going to pay it in a lump sum. So what I'm trying to explain here is that don't confuse yourself with the months that they make use of the fund as they break it down here. What you need to consider is that what is the source of the fund? If the source of the fund is for a specific source, it's going to be on a 12-month basis. However, if it's from a pool of fund, which is we are going to solve an example on a pool of fund, that is when you will consider the month that they make use of the money by prorating it divided by 12. But here, for the fact that the fund is from a specific source of fund and it's not from a pool of fund, we are not going to consider any proration on monthly basis. It's going to be on a 12-month straight period. So this is what we have here. Everything, as they're withdrawing the money, they'll be paying their 15% interest on it. And this is the total interest paid on monthly basis. At the end of the month, they will pay 7.8 million naira as their total interest. However, we have it in the question that the company reinvest their used fund after their first withdrawal on 1st of January. They reinvest their used fund into a short-time borrowing, which will earn them a 5% investment income. When they withdraw this first one, as at 1st of January, they have the remaining funds into their short-term investment, which lasts until 31st of May, which is from 1st of January to 31st of May. That is 5 months period of time. So they will earn an investment income of 5% for 5 months. So that is how we come about this 500,000 inflow here. And for the last withdrawal, as at when they make the second withdrawal, which is 31st of May, from that 31st of May, which is 1st of June, we have June, July, August, September, October. So we are going to calculate it. January, February, March, April, May, June, July, August, September. Before they now withdraw the final withdrawal on 1st of October. So as at the 1st of January, that the fund is made available to them, till when they withdraw it in 1st of October, they will earn an investment income of 5% on that too. So that's how we arrive at these two investment income. The addition of these two investment income is what gives us this 762,500 minus our own gross interest we are going to pay. This one is what we are going to pay our own borrower. This is what we are going to receive from our own creditors, from our own debtors too. From our short-term investments, this is what we are going to receive. This will be an inflow to us. So this will be an inflow to us, while this will be our expected outflow. Now, before we can arrive at our net interest, we are going to remove the investment income from our own expected interest amount too, and that is what gives us this 7,037,500. Now, this is where the meaning of capitalization comes in. This is the total of the asset that we this is total of the fund that we borrowed, and this is our expected finance cost that meets up the capitalization threshold. So the addition of these two is going to be the value of our asset that we are going to recognize in the financial statement. So I'm going to open the floor for us now to ask questions. I know there will be a lot of questions now, so I'm going to open the floor for us to ask questions. Please, just wait till I call your name before you ask your question, please. I know I may be a bit rushed. I'm just looking at the time. Mr. Dauda, please, your question, please.
Thank you very much, sir. Good evening, sir.
Good evening.
So, yeah, looking at the question, when you were trying to, please, can you go back to the solution sheet?
Okay.
Thank you. So, looking at you said less investment income. In the question, I didn't see any place that is stated that we should start our second drawing from 15. Why didn't we start from January 1st, 2007 or whatsoever of 25 million? I don't know. So why did we start deducting from 31st May? Is there a place in the question that stated that we should start our drawing?
This is the question here. This is it here. 31st May. We are told that the loan was used as follows. On 1st of January, 25 million was withdrawn. 31st May, 15 million was withdrawn. And 1st of October, 12 million was withdrawn. So, as at 1st of January, when we withdraw this 25 million, you know, we have our balance to be 30 million. So, out of that 30 million, by May, on 31st of May, we withdraw another 15 million. Now, this is how we come across this 5 months here. From that January that the fund is made available to us till 31st that we withdraw our second withdrawal, that is 5 months. It means that for that period of 5 months, we have earned an investment income on that 15 million that we withdraw as at 31st of May. We have earned an investment income of 312,500. On 31st of October too, on 1st of October, we make our third withdrawal. Now, from 1st of January till 30th of September, before we now withdraw this 12 million, we have earned an investment income of 762,500. Please, have I answered your question, sir?
Okay, I think I'm clear. Thank you very much, sir.
Okay, so it's stated in the question where the second withdrawal is made.
We have nothing to do with the 1st of January 2027.
What do you say?
I said we have nothing to do with the figure for 35 million, the one for
for 25 million. The first of we have withdrawn that already. So we are going to reinvest what we have left from the total fund that we borrowed.
All right, thank you very much.
That is clear.
Yeah.
Oh yeah. So, Madam Ifunaya.
Yes, sir. Good evening, sir. Thank you very much. Please, can you go back to the screen so that I can be able to point my question out?
The solution, right?
Yes, sir.
Okay, this is it.
So I actually have two questions. Number one is the question stated that 55 million was buried, but
Okay.
from all indication, we have 52
We have
million
like 52 million. Yes, thank you for
that
that.
was
What is your
utilized.
second
Please,
question?
where is the 3,000?
What is
That
your
is
second? What?
one.
Okay.
Number two is uh, I'm still trying to understand this 5/12 and 9/12 and the
Okay.
capitalized borrowed cost is not very clear to me, sir. Please, I don't know if you can still explain these investments. I understand the part of 50 million times 5%, 12 million times 5%, but
Okay.
this
Okay.
5/12, 5/12, and this last part, capitalized borrowed cost, is I'm lost in
Okay.
it.
Okay. Okay.
Thank you.
Let me quickly answer that. So your first question in regards to is only 52 million that was used. If you can remember in our last class that I was explaining that I used I think I used that as an example that if he borrowed 100 million and he only used 70 million for the project for qualifying capital expenditure, we are less concerned with the remaining 30 million because we are not going to capitalize the interest that is going to pay. The portion of the interest that belongs to that 30 million, we are not going to capitalize it because what is going to use them for does not concern us as it's not the total of 100 million of what that is. He borrowed 100 million and he used 70 million for qualifying capital expenditure. The remaining 30 million that it does not use for that qualifying capital expenditure, we are not going to capitalize the interest cost that is going to incur on that. Now let's come back to this question. 55 million was borrowed, but only 52 million is being used for this project. It means that from the company budget, they have assumed or they have projected that okay, 55 million is what is going to take us to complete this particular project. However, just as we can see it, only 52 million is being used for this project. It means that only the interest portion, only the interest cost paid on this 52 million is what the company have the right to capitalize. Possibly the remaining 3 million, the company may not use it at all for this project. They may use it for something else. But here from this question, only the 52 million that is being used for that particular qualifying capital expenditure, only the interest cost incurred on this 52 million is what the company is going to capitalize. I hope that answers your first question, ma.
Yes, sir. Yes, sir.
Okay, now the
So,
second
sir, does
question.
that mean the 3 million will be expensed, or we don't have any business with that 3 million?
We don't have any business to do with it.
Okay. All right,
We
sir.
don't have, and the reason why I will not say it's going to be expensive is that they might still use it for a project that meets up with the world qualifying capital expenditure. If they still use it for another project that meets up with the world qualifying capital expenditure, we are going to capitalize the interest portion that they will incur on that too. But as at now that we are solving this question, the question is being silent on it. We assume that only 52 million is being used for this particular project.
Thank you, sir.
So on the second question of 5/12, 9/12, let's go back to the question again. We have it from the question that the company withdraw as at 1st of January 25 million, which means that after they withdraw 25 million, the remaining fund is being kept on the investment income that APC Limited has invested in surplus fund at an interest rate of 5% on temporary basis before these were required for spending. So before the second withdrawal, this particular 15 million that they withdraw on 31st of May has been on investments on short-term investment income from the 1st of January because the fund is available to us on the 1st of January. They're now investing on the short-term investment from that 1st of January till 31st of May that they now make use of it. Now, from that 1st of January to 31st of May, that is 5%. It means that, let me set an example. Maybe you have a friend named Awawu. So you borrow 55 million, and as at 1st of January, you withdraw 25 million for the particular project you want to embark on. You now give this remaining fund to that Awawu to make use of it with an agreement that you are going to pay me 5% interest on this money that I kept with you. And also, I can request for my money anytime. So after January that you take out 25 million, till 31st of May, you now requested for another 15 million. You know, before you request for that 15 million, from that first that you gave the money to her till 31st of May, you are entitled to 5% interest income on that 15 million you wanted to collect as at 31st of May. So the 5% she is going to pay you is what we calculated there, which is the reason why we prorate it. The money only the money only be with her for the period of 5 months, which is from January till May before you collect it. The second one that you collected as at October 2, the money only stay with her from 1st of January till 30 of September. So you are entitled to 5% interest income on this particular fund from 1st of January till 30 of September, which is the reason why we have these two interest income calculated there. I hope this explains your question, man.
Yes, sir. Yes, I just got it now. So that means is how long the money stayed with him or her.
Yes, how long the money stay in the short-term investment before we withdraw it. Before we withdraw it, that is when we are going to receive our short-term investment. So, I don't know if Mr. or Mrs. Precious Ogidigo. Mrs. Precious, please go for it. Or Mr. Precious, sorry.
Sir, you've answered my question already. Thank you.
All right, thank you, ma. What about Mr. or Mrs. Odafe Susan? Huh? Mrs. Susan or Mr. Susan? Okay, Madam or Mr. Ugochi Obina.
Okay. Good evening, sir.
Good evening.
Okay, my question is, we withdraw 55 million, right, according to the question, and
Yes.
what used is 52 million.
Yes.
We knew that it was 52 million based on the question they gave.
Yes.
Now, when I withdrew my 25 million naira, it
remained
it
remaining 30 million.
Yeah, is it 30 million?
It's 30, it remained 30.
Why didn't they capitalize the like investment for that 30 million now?
So the reason why we not capitalize is, I'll say it now, and also I'll say it last week. The reason being that only fund spend on qualifying capital expenditure we are going to capitalize. Only money spent on qualifying capital expenditure we are going to capitalize. Every other sources of spending that the company embark on is left to them. So far it's not on qualifying capital expenditure, we are not going to capitalize it. Both their income and their interest will be dealt with separately.
So I want to ask another question. So in let's say, for example, we have this kind of question in an exam. They will show how they will also show us how they withdraw the money, right? Because
yes, they will show you, they will give you the dates when the money is being withdrawn. They will give you the date when the money is being disbursed to the company. So it's now left to you to now do the plus or minus. Okay, the money is being disbursed to the company on 1st of January. The company made the first withdrawal on that 1st of January. Perfect. They made their second withdrawal in March. So from that 1st in March, that particular money that they will withdraw in March, I could have earned them an investment income. So everything will be stated clearly in the question.
okay, anyone they give us and we disburse and we invest, the rest will be in an investment income.
If the state is that the company invest it, the company may decide that they will not invest it. If the company did not invest it, no problem. If they invest it, then we are going to calculate their investment income.
Okay. Thank you very much, sir.
You're welcome. So Please lower your hand if you have asked your own question. Miss Precious, are you ready to ask your question now? Yes, we are going to get the Excel, the solution. We are going to get it immediately we finish this class. Mrs. Precious, are you ready to ask your question now? Okay, Mrs. Adesola, you can go for it. Mrs. Adesola.
Can you go back on the slide, please?
Okay. This is the question.
Okay, sir. My question is third withdrawal from May to October is not 9 months because I'm not getting it.
Okay. Okay. When was the fund disbursed to the company?
October.
When was the money given to the company from the borrowing house, from the finance house? When did they give the company the fund?
January.
ACTI Limited started construction of an asset of first with a loan of 55 million borrowed at an interest of 15% per annum. So the fund was disbursed to the company on 1st of January 2007. So, and they make their first withdrawal on 1st of that January 2007. So, which means that the fund is disbursed to them as at this 1st of January 2007. So, from the 1st of January 2007 till May, that is 5 months for the fund that they withdraw in May. For the 1st of January till October 1st, that is 9 months, because this 12 million that they will now withdraw in 1st of October is available to them from January, not from May.
All right, sir. Thank you, sir.
So October is when they make their third withdrawal from the 55 million given to them as at 1st of January. So I hope that answers your question, ma.
Yes, sir. Thank you, sir.
Okay.
Sorry, sir. Is that October not 10 months? Because from my calculation, the October is 10 months and September is 9 months.
Okay, thank you very much. When did they withdraw? They withdraw 1st of October. 1st of October. Yes, it means that from 1st of January till 30th of September. It will only be 10 months if they withdraw on 31st of October.
Okay, thank you.
Yes, thank you, ma. So, Mr. Francis. Mr. Francis, please.
Okay, good day, sir.
You are welcome, sir.
Yeah, please, can you go to the solution sheet also?
Please.
Please, I want to confirm something. This 52,000, we are still going to pay it back from where the money was being withdrawn.
Thank you very much.
Then I'm not.
Okay, what is your second question?
Then I'm not trying to ask. Then the surplus for now, we now invest it maybe outside somewhere or something like that, right?
Yes.
Okay, I'm not asking. This 7,800,000 is now the cost of the investment and the cost of the borrowing fund also.
Yes.
Okay, then when paying it back to the people that APC borrowed the money from, are we going to add the 52 million plus the 78 plus the 7,800,000 and give them, or are we adding the 52 million plus the 737 52 million plus
7 million 37,500.
500? Yes. Which one are we adding? Because I think this one is an income and the other one is an expense cost also.
Okay. Thank you very much. Let me quickly clarify that. Let me put that flow here. So the company borrowed 55 million. You agree with me, Abi?
Yes.
And you also agree with me that when we are defining the meaning of borrowing cost, we are very clear that this is the additional cost incurred on qualifying capital expenditure.
Yes, sir.
Now, from this question, it shows that only 52 million is being spent on qualifying capital expenditure. You agree with me on that too?
Yes, sir.
Now, this 7.8 million is the interest we are going to pay on this 52 million that we borrowed, that we use on qualifying capital expenditure. You agree with me on that too?
Yes, sir.
Now, if you borrow me 52 million and you tell me that, young man, you are going to pay me an interest of 7.8 million. If I want to pay you your money together, how much am I going to pay you? Is it only 52 million I will pay you, or I will pay you 52 million plus the interest we agree on?
Plus the interest we agreed on.
Thank you very much. So the company is going to pay back 52 million plus this interest.
Yes, yes.
That is clear. Now, you now see this one.
Yeah,
Are you with me?
yes,
Now,
yes.
this 7,037,000 is
Yeah.
an income to the company. How is it an income to the company?
Because they invested outside.
God bless you. You borrow me 52 million. I also borrow someone. That one is none of your own business. In case
Okay,
the person I
what?
borrowed decided to run away with the money, I don't have any right to give you stories. I will pay you your own money. Now, for me that I take the risk and borrow someone else, the income that the company received from that person that they borrowed is 762,500.
Yes,
Which means
sir.
that this 7.8 million I'm going to pay you. You know I'm paying you this interest, 7.8 million.
Yes,
I've
sir.
now received 762,000 from someone else that makes use of the money that I borrowed them. Is now this 762 million is an investment income to me. In my own book,
Yes.
the total interest I'm paying is not 7.8 million. Is this one? It's 7,037,000 because I have an income of 762,000. But the amount I'm going to pay you is your own 7.8 million.
Yes, sir.
But plus or minus, at the end of the day, the net money I'm paying you is this 7,037,000 because I've also received income of 7,762,500.
Okay. So this 762,500 was less from the 7,800,000. So get the okay.
So the value of my asset now, this is where the meaning of capitalization comes in.
Comes in. Okay.
Value
Thanks, sir.
Initially, the value of the asset is 52 million, which is the money I borrow. However, because I'm spending that 52 million on a qualifying capital expenditure, and also in line with IAS 23, I'm allowed to claim the interest I paid on that 52 million as the value of the asset. That is the reason why I'm adding the 52 million to the net interest paid. This will now be the new value. The value of the asset will now be 59,037,500.
Okay. Thanks so much, sir.
That is the meaning of capitalization there too.
Okay. Thanks so much, sir.
You are welcome, sir. So I think if you continue to take this question, we'll be able to solve the next one. But let me take Mr. Okene question. Mr. Okene, can go for it.
Good evening, sir. I'm a woman. I'm a lady.
Sorry.
Okay, sir. I have two questions here. So the first one is on the calculation of the borrowing cost. So in the slide that you shared, you said for commencement of capitalization, you said so capitalization commences when expenditure for the asset is being incurred.
Yes.
So when you were calculating the first drawn, you did 12/12, meaning because it was taken in January. Then the second one in May, it was still 12/12. So I was confused because they didn't use the fund till May. So why are we now using the 12/12 if an expenditure was just incurred in May? And the same thing for October too. We incurred the expense in October. And we still use 12/12. And the second one is as regards the investment income. So the question said that the excess surplus funds was invested. So in January, out of 55 million, in January, we took out 25 million, it remained 30 million. Then in May, we took out 15 million out of the 30, it remained 15 million. So the calculation is just really confusing because we use 15 and 12 when we still have I don't know if you understand what I'm trying to explain.
Understand.
Okay, sir. Thank you.
So this is the answer to your first question on the reason why we did not prorate month. I said it before we start solving the class. from the question, from the note, you will see that there are two sources, there are two likely sources of fund. Either is a specific fund or a pool of fund. A specific fund is something like this, that okay, I approach a bank, give me that 55 million. I want to build a house. It's a specific fund. I borrow that fund specifically for that project. A pool of fund is a situation whereby I will borrow from you, I will borrow from Mr. Dauda, I will borrow from Mr. This, I will borrow from Mr. That. I will borrow from different sources and using it to finance a single project. Now, if the sources of borrowing is from a specific fund, is from a specific source, you are not going to prorate the month. And this is the reason why I will start an example now. If I approach you and I say, okay, madam, please borrow me 10,000 naira. I'm going to use your 10,000 for 1 year, and I will pay you an interest of 2,000, making 12,000. In my first month, I use 5,000 for a project. In my second month, I use 2,000 for a project. You know, it remains 3,000. If I want to pay your whole interest, you now pay you, okay, in first month, I will pay you your 10% complete. But in second month, because I've not used the remaining fund, I will not pay your full interest. It's not going to be possible. The agreement on the question is that, let me open the question. I think that will explain better. See it here, 15% per annum. The interest is per annum. The agreed interest is per annum. Irrespective of when you use the money, that is palaba of the company. The borrower is less concerned with that one. I've borrowed you 55 million and we have agreed on 15% interest rate per annum. Yearly from that 55 million, you are expected to pay me 15 million. You are expected to pay me 15%. Irrespective of maybe you use the money in January or you use it in December, that is the company consign. It's none of the borrower consign again. The agreement is from a specific pool of fund, 15% per annum. So irrespective of when the company withdraw the money, they are expected to pay their full year interest rate because that is what they are agreeing on. And also the source of the fund is from a specific pool of from a specific source of funds. I hope that answered the first question.
Yes, I did. Thank you, sir.
Now, on the second question that you said that when they withdraw the money, I will say this again. Only the funds spent on qualifying capital expenditure meets up the capitalization threshold. Only 52 million is being spent on this project, and the 52 million was not withdrawn at once. It was withdrawn in piecemeal. When we withdraw our first withdrawal, we have left certain funds that we invest in the short-term investment income. From the period that we have the money with us till when we withdraw our second withdrawal, that is where we are going to capitalize our investment income, which is what we did here. The same thing happened to the third withdrawal too. I hope that answers the second question too.
Yes, I did. Thank you, sir.
You're welcome. Mr. Johnson. Mr. Johnson. Okay, it's not there. Mr. Johnson Ochimana. Okay, it's not there. Mr. Precious.
Please, Miss Precious, sir.
Okay, sorry, please, Miss Precious. Sorry.
Sir, please, how did you get the 762,500, the inflow?
Okay, this is it. The addition of this investment, the addition of this interest income is what gives us this one.
Okay.
Yes.
All right, thank you.
Sorry, sir. Hello, sir.
Hello, yeah, I'm with you.
Sir, where I'm a little bit confused is about the money that was borrowed. From the calculation, the borrowing institution gave 55 million, and they were able to use 52 million. Is it that they are not going to account for the remaining 3 million?
Definitely, we account for it. The only thing we are dealing with here is portion of the fund that we spent on qualifying capital expenditure. Maybe, you know, when the company wants to embark on the project, they might have forecast that they will be spending a total of 55 million. But maybe due to some certain reason, this company now later spent 52 million. You know, because they have borrowed 55 million, they cannot come and say that, okay, because you have borrowed 55 million, we are going to capitalize the whole 55, the whole interest rate on the 55 million. No, only the 52 million that is being spent on the qualifying capital expenditure is what they will capitalize, is what they will add to their value of the assets.
Okay, sir. Okay.
All right.
Thank you.
So, last question from Mr. Frank. Mr. Frank? Mr. Frank? All right. So, should we move to the second question, or we will postpone it to next class?
No,
let's move to the second question.
All right. I'm going to move those again. I will explain the second question, then we ask our question after that. The second question is an example of money borrowed from a pool of funds. A pool of funds involves borrowing from more than one sources. I've said that if that is the scenario, just that it's not going to be possible for us to be, you know, we borrow from like 4 different sources. How do we get our interest rate that we're going to use now that our sources of borrowing involve more than one source? What we are going to do, we are going to calculate weighted average cost of capital. And the formula for calculating weighted average cost of capital is the total interest divided by the total fund borrowed. What do you mean by total interest? It means that the interest we are going to pay on the first borrower, the second borrower, the third borrower, the total interest, we add everything together, divided by the total fund that we borrowed. In example here, we have Pretty Duni Limited. Now, let's look at what Pretty Duni Limited have for us. Pretty Duni Limited agreed, Pretty Duni Limited PLC, a J company, has the following loan arrangement as at okay. Pretty Duni PLC, a J company, has the following loan arrangement as at 1st of January 2025. These are the loan arrangement. Loan notes of 10%, another one of 15%, another of 12%, another one of 6%, bank loan. Then another one is bank overdraft again. On the 1st of January, just like they told us that the company is highly geared, which means it's exposed to a lot of debt financing. On 1st of January 2025, the company commenced the construction of a new office factory, which is expected to take a year to build. The company expects to fund the construction from the existing borrowing, that is, from the pool of funds. The following expenditure were made during the period. This is the first drawing, second, third, and fourth. The company investment manager has suggested that the temporary available surplus fund is, if any, can be invested at 5% payable monthly in arrears. Monthly in arrears, that is, they will be paid in like an accrued manner. The company back overdraft as at 31st X5 amounted to 260, with weighted average of 200,000. The interest charge on overdraft amounted to $17,400,000, and none of the existing loans have been redeemed as at 31st December. Calculate the borrowing cost and also calculate the assets value to be included in the statement of financial position. This is the work, which is what we are going to use to get our interest. This is it here. This is the addition of all interest, which is the 10% on 175, the 12% on 180, the 6% on 660, on 60 million. This is it. Then the addition of all the fund, 175, 280, 80, 60. This is it here too. So the division of these two is what gives us 11.3%. So it means that 11.3% is what we are going to use as our interest rate. Now I told you that we will not consider the month of withdrawal if you are using a specific sources of finance. But if you are using a pool of finance, we are going to consider a source, the amount of withdrawal. And this is what happened here. So our first withdrawal is on January, which is that particular interest will be paid on the 12th month from January to December. Our second withdrawal is on 31st March. It means that the interest we are going to pay there will only cover 9 months. The third one is in June. The interest will be 3 months. The fourth one is on October, and the interest is 3 months. So I believe this is very straightforward based on our previous example. This is what we arrive at, and just like we have, in this question, we are told that the company have the opportunity to invest their surplus in an investment income, but we are not sure maybe they did it or not. So this question is being solved with the assumption that the company did not actually exploit their investment income. Because purposely, what I want to use this example to explain is fund from a pool of funds. So I'll give an example that if the company decided to have an investment income too, we only calculate the outstanding fund that they have in their investment income and the interest income being attached to it. But here in the question, we are not told that the company actually exploit the suggestion that is being made to them. Actually, the manager has suggested that temporary fund surplus, if any, can be invested. And we are not told that there is any surplus fund. We are only told that the fund manager suggests to them. So we assume that there is no any investment to them. Please, let's make the question very simple and, to avoid repetition. I'm going to open the floor for us now to ask our question. Please, is there any question? You can't see the screen. Please, can you refresh? Can you confirm if you can all see the screen, please?
Yes, we can.
Okay. So I'm opening the queue now. We only have 2 people that raise their hand up. Anybody else again before I start calling them? Anybody else again, please? Okay, Mr. Johnson, you can go for it. Mr. Johnson. Okay, Mr. Obina.
Okay, thank you very much, sir. I don't understand how you calculated the weighted average, and why are we calculating weighted average? It's not the same as the last question. I'm kind of confused. I said I don't understand how we calculated the weighted average, and why are we calculating weighted average? It's not the same as what we did the last time.
Okay, thank you for that. The last question we solved was from a single source of borrowing. The company approached a bank and they borrowed 55 million. Very straightforward, no question, nothing. Why this particular pretty doing? We are told that it's a very high-yield company, which means that the company is being financed with a lot of debt, with a lot of sources of debt. So here they have different sources of borrowing, and this is it here. This is it. This is a 10% non-note. This is another 15%. This is another 12%. This is a bank overdraft of 6%. They have more than single sources of borrowing. They are using multiple sources of borrowing to finance their project. So due to that reason, that they are using multiple sources of finance to finance their borrowing, it means that we cannot just say that, okay, if we decide that, okay, this first 30 million that they withdraw now, where did they withdraw it from? We can't know, because they have more than a single sources of borrowing. Unlike that first one, that their first withdrawal is from their 55 million of 15% per annum. But yet they have multiple sources, they have multiple percent, they have multiple interest rates. So they only take this 30 million from everything they have here. So what can we do to have a single finance interest rate? We need to go with our weighted average cost of capital. How do we go with our WACC? This is the formula here. This is the formula. How's the formula? This is the formula here. Total interest divided by total fund multiplied by 100%. What is the total interest? The total interest means the interest on this 175 million, the interest on this 18 million, the interest on this 60 million, plus the interest on, let me add it to it, the interest on the back of a draft. We could have calculated the interest on the back of a draft too, but however, we are so lucky that we are giving the interest directly from the question, and this is it here on the question. We are giving it here that the interest charges on back overdraft amounted to 17,400,000, which means that we are not going to calculate this back overdraft loan again. We are only going to calculate this one plus this one plus this one. The interest on this bank overdraft has been given to us directly as 17,400,000. Let me add it to it here. Let me add it to it here. 17,400,000. So we add the interest together. We calculated the interest on 175 million to be 10%, on the second one to be 12%, on the third one to be 6%. Why the fourth one is given to us directly? So we add everything together and it gives us this 90 million. Why the actual fund that we are paying interest on, the first one is 175, 280, 80, and 60. We have it here in the question. This is it. The three of this. We add everything together. You get. So that is how we get our work. The addition of this is what gives us this 795. The division of this will give us the 11.3 interest rate we are using. I hope that answers your question, man.
Yes, sir. Sorry, where are we getting that 180 million from? Because from the question, I'm not seeing 180 million. No. I'm seeing 80 million only.
So where do you see 180 million?
In your calculation in the Excel work, that's 12% times 180
That is a mistake. It's 80 million.
Okay, check. Okay.
It's 80 million. Do you have any other question? Okay.
No, thank you.
Mr. Olusoji.
Thank you, sir. Please, the loan note we are giving two, one for 10% and 15%. It's only one we are using. So why are we using only one? The loan note we are giving.
Okay, we use the two. We use both.
We use the two, but the percentage we apply was 10%.
Okay.
There's no 15% in the calculation.
Okay, hold on.
Thank you, sir.
$280 is 15%. So this one is 280. 15%. $280, 15% is it here? $280, 15%, 12% on 80, 10% on 175. So we use it. This place there's a typing error here. That is why we have 1575, 280. This is the actual formula that I use here. Let me copy it so that I will not confuse you. Oh, no. I'm wrong. $10 on 15, 12 on 80, 15 on 280. 15 on 280, 12. In fact, I've not included that 12 on 80 to it at all. Okay. So this is, if you check the formula that I use here, this is the actual calculation I did. The 10% on 175, 12% on 80, 15% on 280, 6% on 60, and the one on back overdraft that is being given to us directly. So I hope that answers your question, sir.
Yes, sir. Thank you, sir. Then another observation, sir. The bank overdraft is only the interest we make use of. We don't make use of the real amount that we added from the total amount, total fund borrow.
How much is the bank overdraft? How much is it? Is it not 200 million?
Okay, I've not.
This is it here. We have it from the formula direct. Yeah, this is it. This is it here. Check the formula direct here. This is the formula.
Okay.
This one
Okay,
is just for us to know the breakdown. Yeah, I think I'll omit it here.
Thank you. I've seen it. Thank you.
I'll omit it here. I think that is what is causing this. So,
yes, it was omitted.
Where I put the formula, you get this is it here. So there's formula here. So I just want us to have the breakdown of this formula. That is why I also decided to put it here for us. So any other question? Hope that answers your question, sir, Mr.
Thank you, sir.
All right. So do you have any other question?
No, sir.
Let me check it here. Mr. Ada, okay.
No, sir.
Okay, all right. So can we still solve the last question tonight? So the last question, is just a combination of the first type of example and the second type of example. And that is also a past question. This is the one I'm trying to solve for us last week. So should we have the solution here? With this first and second example, we should be able to get it. It's just a combination of the two, whereby a single company borrow from a specific fund and also borrow from a pool of funds. For that specific fund, we make use of the direct agreed interest rate, while for the pool of funds, we make use of our weighted average cost of capital, which is this one that we calculated there. If you check through everything is best explained. I don't know, should I still explain it tonight? Because I see people are going off already.
Just a summary, sir.
Let's continue.
Sir, you can drop it on the group.
No, sir, if you can have a little class tomorrow evening to explain it very well, it would be nice. Like maybe a 1 hour class.
Yeah, no, continue. We need to
continue, okay, when others are leaving. It's night already. Some of us are going to work tomorrow morning.
Tomorrow, because some of us don't want to.
You can make a 1 hour class tomorrow.
Let's hold on. Let's hold on. Do you have any class tomorrow?
Yes.
We have classes tomorrow, so I don't think it's going to
be. We do have classes tomorrow. We do.
I suggest we continue. Then maybe they'll watch it on YouTube or something like that.
Anybody wants to be sure?
Oh, we are feeling sleeping already.
Okay.
What are feeling sleepy already?
No problem. This is what we are going to do. This is what we are going to do.
Can you watch?
Hold on, please, this is what we are going to do. I'm going to drop this solution to the group chat.
Thank you, sir.
With the assumption that if we go through the first example and the second example, you should be able to get this too. There's nothing special here. Don't look at the figure. It's just normal thing. A single company, they borrow from two types of sources. They borrow from specific sources and they also borrow from a pool of funds. So we just like we did our example, I've even included here. See, all these ones you are seeing here, they are from specific funds. It's stated in the question. Every withdrawal that the company did, they will tell us that okay, this withdrawal is from specific fund. This withdrawal is from pool of funds. So the first withdrawal is from pool of funds. We make use of this 9.58. You get, and this last withdrawal too is from pool of fund. We make use of this 9.58. Why everything from this place to this place is from the specific fund? We make use of the single figure. And also remember what I told you, that we will not prorate anything. If you are borrowing from a specific fund, it's going to be on normal on the normal this thing, on the normal period, on the normal the actual month. The specific period this is being used for 9 months. So every withdrawal that they did from it is being on 9 months. While from a pool of fund, you know, we consider months. You see now, this one is for 11 months. This one is for only 1 month. We calculated everything. They also have a short-term investment income. You see it here. So just go through it. I suggest we also end it here. But I believe with this explanation, we should be able to get it. However, if you have any question, no problem. We are going to meet in our next class. Although I'm also starting my a top-up program that I'm running. I'm starting the exam this weekend, and it's going to run through this week, next week, and also last week of August. However, on Monday, we are going to meet specifically to address any question we have on this, and we'll be also looking at IFRS 13. IFRS 13. So we are going to do the two together. Just go through this thing, go through it very well. It's very simple. We have it's a past question. Go through it. Use the first example, use the second example. Anything you don't understand on it, I would not want to say you can reach out to me. I may not be able to attend to your private WhatsApp chat. However, you can still reach out to me if you have a very question on any question on this. You can reach out to me on WhatsApp. I'm going to use my voice note. In case I'm seeing this question from multiple sources, I'm going to use my voice note to explain it and drop it in the group chat. So I hope you are all fine with it like that.
Yes, use the voice note and explain it. Thank you very much, sir.
We are fine with you.
If we have questions, if you reach out to me that you have questions, so I'm going to use my voice note to explain. So,
Hey, sir, I have question.
What is your question?
Sorry for taking you back. The previous question that you solved, number 2, for the investment. So you did 25 plus 15. No, not this one. The next question. The next one. Yes. So development cost 30, 25, 20, 15. The addition, you put 52 million.
Don't mind me.
Okay, it should be 90. Okay. Thank you, sir. That's one.
It's not 90. It should be this. It should be this, not 90.
Oh, okay, sir.
It should be this. This is the fund. This is the actual. This is the total. This is the actual fund that they borrowed and used for the project.
Okay. Thank you very much, sir.
This is it here. You have 30, 25, 20, 40. This is it. It should be this one. Sorry. This 30, 25, 20, 40. The actual fund that we spent on the project. Yet, let's do this together.
So you say it's not 90? It's 90.
No. 90 is the interest. Is it 90 if we add everything here together?
Yes. No. It's the development fund.
Cost.
Yes.
Cost of
the development cost.
115.
What do you say?
Development fund is 90. Development cost is 90.
No, development cost 30, 25, 20, 15.
The mistake I made is that I'm bringing this figure there. You see, 25 plus 15 plus 12.
So it's 115.
It's 115.
115, yes. Thank
40
you.
and not 15 there.
Take off 15 to 40, yeah.
40.
Yeah.
So we are going to have 115 here. Thank you very much for that question, man. Thank you very much. So just like we have 25, 15, 12 here, this place 2 is 30 plus this is 55. This is this 2 here is 50, 55 plus 50, that is 150. So thank you very much. So we call it a day tonight. Have a wonderful night rest. I'm going to drop the
Thank you,
solution tonight.
Okay, thank you very much, sir. Sir,
Thank
remember
you,
to
sir.
drop the voice
Good
note of
night,
the
sir. God
explanation.
bless you.
All right, no problem.
Thank you.
Thank you so much, sir. God bless you, sir.
Thank you,
Thank you
sir.
so much. God
God
bless
bless
you.
you.
Thank
We
you, sir. Good
appreciate.
night.